Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. I have a singular big picture item here on this daily chart that is nearly 2 years old. It is the big June to October 22 to April 2024 bear channel, currently 206 to well off the bottom of my daily chart. This bear channel is still highlighted in dark blue on my daily chart and is only since mid-April this year that we saw it broken on the upside. But it's still so significant that I've kept it highlighted, and it's also still on my daily chart. That's why I've done it still. So on the 22nd of April, exact date, prices punched up through this dark blue highlighted upper bear channel line and moved further up over the long moving average, currently 229, hesitating for a short while just under the bright red highlighted neckline extension of the June to November 2023 head and shoulders top. That's currently at 235, before breaking up through and into the congestion between 252 to 255, containing the 2013 high at 254, and utilizing that congestion as a support rather than resistance. The market next moved up through the 258 to 260 congestion containing the 2022 low at 258, before coming to arguably the most difficult overhead congestion between 267 to 270, where the market was capped at the end of May. In the process of moving higher, the market created a very steep and acute late April to late May bull channel, highlighted in purple on my daily chart. So, before I deal with this bull channel, let's go back a bit to that break of that big old bear channel. The break higher gives a primary target X for the move up in the 277 area, with a secondary harder to reach target X1 up in the 312 area, which is up off the top of my daily chart right now. So what stopped it rising and turned the market into a V-top? Well, it was that 267 to 270 resistance area. I had repeatedly said how this resistance is quite reasonable and quite congested. I now draw your attention to the exit below out of the purple highlighted bull channel and into a new pattern, a pink highlighted, June based, quite acute, relatively narrow bear channel, as we left behind a V-top currently at 230, the actual channels at 232 to 247. The move lower has been quite dramatic and still is. I spoke on this 2 weeks ago where I said, and I quote, gives us some new opportunities on the downside without ruling out the larger, longer term potentials on the upside. You could call this all a possible diversion, if you will. Thus we have a potential target X2 down in the 244 zone and a secondary hard reach target X3 down in the 233 zone. In theory, even dropping down to target X3 at 233 would still keep targets X and X1 above still alive. But I imagine might have developed some newer patterns by then, should prices venture that far. End of quote. Today, Friday, prices have reached the primary target X2 at 244 on the downside. So you may think the move lower to the secondary target X3 at 233 would be a possible shoe-in. And part of me would like to agree, but I cannot fully agree, as below current levels we have some interesting supports. As I said last week, and I quote, between the primary target X2 and the secondary target X3, we have some considerable supports which I have highlighted earlier when the market was moving higher, notably the bright red neckline extension currently at 235, the green and rising short medium moving average currently 240, as well as congestion at 234, 238, 240 and 242. End of quote. Let's see what the market does with these this coming week, as well as how it handles the acute pink highlighted bear channel that is currently sitting within. Minneapolis wheat. And apologies for some of the labels being highlighted in bright red on my daily chart. Sometimes my charting system throws a wobbler and does this sort of thing unintentionally. So please note there is no special meaning in any of the labels being highlighted in bright red. Back in late February 2023, and especially at the start of April last year, so it's now outside the parameters of my daily chart. The market constructed a large bear channel that morphed into what is now highlighted in dark blue on my daily chart, a descending, expanding wedge pattern, which is 715 to down well off the bottom of my daily chart. The upper trend line is currently escorted and reinforced, and has been for some time, though not very well recently, I have to say, by the gold highlighted declining long moving average. Right, it was highlighted, it's not highlighted anymore, but it's currently at 713. Going back a bit to early December last year, the short medium moving average started capping prices. In truth, this moving average had been an effective cap on the market since mid-October 2023. Not tested, but effective nonetheless. However, on the 22nd of April, after some base building since late February, the market broke higher over the short medium moving average, as well as the mauve highlighted medium moving average, currently at 685, and some other significant resistances in a band between 693 to 708. In this band, we also had two other patterns I'd spotted earlier, nestling like Russian dolls, one within another. 32 weeks ago, I said the following with the first pattern highlighted in purple on my daily chart, and I quote, "It is the nascent August to date," so that's August 2023, "it is the nascent August to date bear channel, currently 668 to well off the bottom of my daily chart." Once again, I note how we have a smaller bear pattern nestled within a larger one, much like a Russian doll, end of quote. The second pattern actually is no longer highlighted, as the October 23 to late April bear channel, currently 570 to 672. Now, this earlier pattern has seen some touches and likewise was also broken. Prices 3 weeks ago exited up and out of the 693 to 708 congestion band, created a steep, acute and ultimately short-lived late April to early June bull channel, highlighted in bright red on my daily chart. This original break higher gave me the opportunity to consider things on the top side. Thus, for the big dark blue expanding wedge pattern, we have a primary target X in the 878 area. The harder to reach target X1 in the 928 area. This second area is well up off the top of my daily chart. For the purple highlighted bear channel, we had a primary target in the 777 area, the secondary hard to reach target X3 up in the 820 area. The primary target here was just about achieved. For the unhighlighted bear channel, both primary and secondary targets had previously been achieved. So I'll just let that sink in for a few moments, and then we'll look at obstacles preventing the market reaching those harder primary and secondary targets, and what turned the market lower at the end of May. First up, the capping of the market 2 weeks ago, and that was the July 2021 low at 778. Initially, it didn't look that aggressive, but it stopped the rise and turned the market lower, back down within the dark blue descending wedge pattern, back below the gold highlighted, and down through the gold highlighted, the long moving average, and down through many supports that are now resistances. This week, prices dropped down below the short medium moving average and the mauve highlighted medium moving average, that's currently at 685. And as I said last week, and I quote, "You could easily see prices head back down to the purple upper trend line, currently at 664, as this is the area where we have a wide congestion band formed over February to April between roughly 640 to 675. Now, should we get down there, then it would not be the end of the world for any previous break higher, though it would indicate that the April to June move higher was at least the large, large dark blue descending pattern, a false break higher, and possibly for the purple one, a limited fulfillment of just the primary target, end of quote. I further added, and I quote, "But I think it would be best to see what the market constructs should we get down there before totally retiring those big topside targets," end of quote. Well, we are down here now, so let's see what the market would choose to do next. However, I would point out one feature, a new feature that may well be broken in the next day or so, and that is the June-based, very narrow, very acute and small bear channel, currently 620 to 668, highlighted in bright pink on my daily chart. There's only one way for this pattern to go, and that is down, as it's so narrow, and I'm wondering if the market has the discipline to keep within that bear channel or not. London UK feed week. One of the key features here on my daily chart is, and it is a surprising feature, has been and still is the extension of the neckline, the May to June 2023 reverse head and shoulders bottom, currently at 192.60, which is highlighted in dark blue on my daily chart. Originally, this was not a very notable pattern, a mini reverse head and shoulders pattern, if you will, but the extension of the neckline first acted as a pretty reasonable support, and then recently as an additional resistance, though I suspect in the background, back then, the September 2021 low at 181.70, and perhaps more importantly, the 50% absolute Fibonacci line at 180.5 had helped in the past to prop up prices. Now, this year in late April, and however briefly, to cap prices before possibly acting last week as a temporary support. Looking at more recent action, we had a double bottom during February and March, with prices moving up through the old congestion from March to April 2019 between 161.95 to 165.75, as well as the July 2021 low and the May 2023 lows, both at 164 even, and the August 2020 low at 161 even, reaching the target area for the double bottom in the 170 even region. We then had some hesitation under and around the mauve highlighted medium moving average, currently 173.5, between mid-March to mid-April. The mauve medium moving average had been an effective cap for this market since about late 2023, becoming more significant as we headed into December 2023. In April, this cap became an ascending triangle, and from this pattern, prices pushed up higher on the 22nd of April, reaching both the primary and secondary targets above for the pattern. However, the market then came into contact not only with the 50% absolute Fibonacci line and the September 2021 low, but also the slowly declining long moving average, currently at 179.40. At the end of the first week of May, prices punched up through all three of these, establishing itself over all of them. This left just a dark blue neckline, or rather the dark blue neckline that is over a band of congestion formed between roughly August 2023 to early January 2024, between about 183 to 189. I said 5 weeks and I quote, "I am not sure how good this band of congestion really is, and I'm also not sure how good the dark blue neckline is as a resistance without the help of the 50% absolute Fibonacci line in December 2021 low. But having come so far, it would be wasteful to not look further higher. Thus, looking at the triangle as a halfway hesitation, we could see a potential up as far as just under the neckline and above the 183-189 congestion, up in the 190.75 area." End of quote. Prices made a forced but significant break higher 4 weeks ago, and then 2 weeks ago they made a truer break higher, up through the August 2021 high at 199.20 and peaking just under the March 2013 high at 205.05. Now, I said just a few months ago how the break 4 weeks ago was false but significant. The reason why was because it helped define an early March to early June bull channel, highlighted in purple on my daily chart. And though it was part of a weekly key reversal down, the action 3 weeks ago justified that weekly key reversal down as a false break. Then last week the market broke lower, down through the purple lower trend line and the dark blue neckline, virtually at the same time, as the market could not break higher through the top of the purple bull channel and through the March 2013 high at 205.05, creating a sharp V-top and very late May to date bright red, very acute and narrow bear channel. That's currently 167.10 to 175.95. As I said last week, when the first break below the purple bull channel and dark blue neckline combination happened, and I quote, "It's now up to the market to exploit that move lower. It does, it will not only have to overcome the previously mentioned congestion between 183 to 189, but also the congestion below between 179.70 to 181.70, which contains the long and short medium moving averages, as well as the September 2021 low and the 50% absolute Fibonacci line. My current view is that despite the congestion seen back between roughly late August 2023 to early January 2024, that it may be the lower congestion that is the more serious." End of quote. Well, prices took on all those congestions and shot through them, such that we are now right back to the hesitation area that became a small ascending triangle back in April, roughly between 168 to 174. Will we hesitate here again, but this time on the way down? Possibly, but the overhang of the market is bigger than this old ascending triangle, and I'd suggest looking lower, down to the old double bottom of February and March, and below the congestion lows you can see on my daily chart between 161 even and 165.75. The only counter to this is that the bright red bare channel is very, very narrow and very acute, and thus susceptible to an easy breakout. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Toftpick and ADM Investor Service International Limited. And here comes the final important bit.